There's a moment I'll never forget. And it wasn't the market crashing. It wasn't the loans freezing. It was actually standing in the grocery store aisle, staring at a jar of mayonnaise, trying to decide which one I was going to buy because I needed to actually save the 30 cents. And that's what happens when you've lost millions. And it's a story I'm going to tell you today. See, back in 2008, I had what most people called made it. I had over $28 million worth of work on the books. I had deals all over the valley, 50 employees working full-time, and lenders lining up to do our projects. And then, like everybody else, the lights went off and it all stopped. The banks froze, my clients panicked, and every margin, every projection, and every spreadsheet just melted. I watched it all go out the window faster than snow on asphalt in August. I had partners calling me daily, banks calling me hourly, wondering what happened. I had payroll due. In fact, I got a call from my insurance agent, and I needed to pay my insurance premium for next year. And like every year before that, I'd paid it all at the beginning of the year. And it was $72,000, and I didn't have it. We looked at a payment plan. We looked at all the options, and it just wasn't penciling. And I had deals that were 90% complete, but couldn't get the funding to finish the last 10%. That's worse than never starting. Honestly, it's done. You're right there. You can see it, but it's just not going to move forward. I went from making multi-million-dollar decisions to wondering what mayonnaise to buy and if I could afford the actual premium peanut butter, the kind that my kids liked. And that's not an exaggeration. That's what financial trauma looks like. But here's the thing. I didn't just lose money. I lost my confidence. I lost my marriage. I lost trust in myself. And worst of all, I lost time. I lost years of it, chasing recovery instead of building. And I don't want that to happen to you guys. So let me tell you, what did I learn? Well, here's the honest truth. Cash flow isn't optional. If your deal doesn't cash flow on day one, don't do it. If you don't have multiple exit strategies, don't do it. I don't care how pretty the pro forma looks. A pretty Excel file doesn't pay the mortgage. It doesn't pay the creditors. And you can't eat equity is the second thing I would tell you. I was equity rich and liquidity poor. The market turned, and suddenly all the value that I had, the $750,000 signature loan, the banks lined up to fund the next draw, all of that was gone. And liquidity was my lifeline, and I didn't have it, and I didn't protect it. You guys need to do that. Number 3, debt is a tool. I found out very quickly that I was over-leveraged. I didn't think I was. But when the tide turned, as Buffett says, I was swimming naked. Now, I operate with way more breathing room. My rents can drop 30% before I'll miss a loan payment. Most of my apartment complexes, they're built bigger. What I mean by that is all of my units are 10 to 12% larger than anything else in the market. And that costs money, but when the rents drop, I can hold mine longer than anybody else. That allows me more liquidity on what I've already spent, making another fail-safe, if you will, in my pro formas. And number 4, this is the most crucial. Mindset is everything. Because you know what's funny? I didn't feel rich when I was rich. I just felt really busy. I didn't feel poor when I was broke. I felt stupid. I felt shame. I felt embarrassed. And that kind of shame will mess with your head. So today, I spend a lot more time protecting my mindset than my balance sheet. Fast forward to now, we're in a different cycle, but I'm seeing the same behaviors I saw in 7 and 8 and 9. People were overpaying in 22 for value add, deals that were razor thin, hoping they could squeeze out an 8% rent bump in a 5% wage growth market. That just doesn't happen, people. That's not a strategy, that's gambling. That's speculation. Me, I'm back in development, but it's not just about breaking ground, it's about breaking patterns. Every deal I do today is underwritten extremely conservatively. Why? Because I'm just not prepared to come back to my partners again and admit that I have no answers. I'm not just protecting my capital anymore, I'm protecting my investors, I'm protecting the balance sheet, and I'm protecting myself. See, one of the most humbling moments of 2008 wasn't writing checks. It was calling partners and saying, your money's gone. And I swore I'd never make that call again. In fact, after that, it got worse because I didn't protect my mindset and I let it take me down some dark roads. And I wound up building back a trucking company. And I was actually one of the drivers. And I remember I was standing in a shower in a truck stop in Bozeman, Montana, in flip-flops. And I was standing there going, what happened? What do I have to do to get out of this? What do I need to do to change this course? And that's when you realize that your money's gone. Well, I swore I'd never make that call again, and that's why my investors get paid first. And here's the funny thing. That shift from profit first to investor first has made us more profitable than ever because trust is a compounding asset. Look, here's the reality. A lot of things are already breaking. The cracks are showing in commercial, multifamily deals, industrial deals, in every deal that was built with the assumptions instead of cash flow. It's similar to 2010 all over again. And for those that know how to underwrite properly, understand capital discipline, understand partner relationships, it isn't a crisis, it's a window. It's a massive, massive windfall if you're prepared. And that's where we are right now, quietly buying well-located, conservatively structured assets while the noise chases rates, chases rate cuts, and wishful thinking. We're not looking for everyone. We're looking for the few, the accredited investors who understand the cycle, who understand what it's about, and for what it is. It's an opportunity for the disciplined, not the desperate. If that's you, if you're thinking long-term, if you care more about downside protection than glossy decks, if you're looking to work with an operator who's been through the fire, we're open to a conversation. This isn't a pitch. There's no webinar. There's no fast countdown. There's no run to the back of the room. It's a one-on-one call. That's it. You're going to ask your questions. We'll ask ours. And if there's a fit, we'll take it to the next step. Click the link to apply. We'll review every submission. And if it makes sense, let's talk. If you think raising capital is hard, in 2019, I needed $20 million almost overnight. I had a deal ready to go. It was zoned, designed, banks were done, shovel ready. And my capital partner bailed at the last second. In the next video, I'll show you exactly what I did, how I rebuilt the entire capital stack from scratch in under 90 days. You can watch that here.